Welcome back everybody. So I haven't done videos in a while, so this will be my first video in a while, and this is a random video and I thought it was interesting and should cover it. So this is how we calculate, I'm gonna go over how we calculate what percentage you should actually offer your venture capitalists if you start a business and you pitch your business to get money in exchange for equity. So let's say that we need a company to compare to. So we find a similar public company and we have all their financial details. And what we find is that in year five, so this would be our public company over here. So this is our public, and this is our company. So this is ours. So this is their earnings is $5 million in year five. I don't know if you can actually see that, but that's actually $5 million. But what the market valued them, the market that is the general public, what they valued that company with earnings of 5 million is 50 million. So the market valued this company, this public company, which is earning $5 million at 50 million. So the price to earnings ratio is actually 10. Just 50 divided by 10 or 5 times 10 to get the number according to what we times or divided by. So this is our graph, and we're a private startup. So what we actually have is we didn't actually go public in year five, so our earnings at year five is only 100K. So we're using the same PE ratio as the public company, that is 10. Our market cap would actually be 1 million. So the thing about public and our company is the amount of people, what they're doing. That doesn't really matter. All we're really interested in is getting the PE ratio, and we're using the PE ratio to get what our market cap is. Because if they could do it, then we could achieve the same PE ratio theoretically. So here is our equation, and pretty much M is the money you need to raise, R is the rate of return that your venture capitalists want, Y is the year, and W is what their investment is worth at year Y. So here's the example. Suppose that the expected earnings in year five is 100K. So that's what we went through, the expected earnings in year five to be 100K. And comparisons reveal that the price to earnings ratio was actually 10, like we said here, like in this graph. So the value should be at 1 million. And that's what we have here in this graph. So if we need 50 grand to start our company to get going, and our VCs want 50% ROR, or the rate of return, which is R, then what is their expected investment worth at year five? What is their investment worth at year five? W. So let's use this equation. So we find that we needed 50K to start. So M is the money that we need to raise, and that's 50K. And our ROR, what the VCs want is they want a 50% rate of return. So 0.05 is 50%, and that's at year five. That's over 5 years span. So what their expected investment is worth at year five is actually 380K. So therefore, we expect to provide them with 38% of our equity, 30% equity for 50K investment. So you may have the question, where did I get 30% from? Well, it's actually pretty simple. We actually just took our market cap, which is 1 million, what we hope to achieve by year five, so 1 million, and then we just have 380K over 1 million. That gives us 0.38 or 38%, right? It's pretty simple. So what I want to say or get across in this video is that you should really do your calculations, because if investors are asking for 50% ROR, then they should really get 380K or 38% equity stake. So if they ask for 50% ROR and a 50% equity stake, then um, what's really happening is they're scamming you, and that is really not what you want to at all for your hard work. So you really want to do the calculations. At 50% ROR, they really only deserve 38% equity, not 50% equity for a 50% ROR. And you could really easily just recalculate a lot of stuff. So, for example, let's say that by the end of the 5 years, these guys want 500K. So they want 500K. Then using the same equation, we can how much of the percentage, how much ROR they actually want, right? It's because just 50K times one plus rate over 5 years for the years. So if they want a 500K, if they want their expected investment at year 5 to be worth 500K, then we just take 50K and divide by 500K. So 500 divided by 50, which is pretty much 10, right? Yeah, my math is going bad. So pretty much we have root 5 uh, of 10, fifth root of 10, and 1 plus r. 1 plus r. And the 5 over here, we got rid of it because if we take it to the fifth root of 10, then it's pretty much just 1 plus r, right? So yeah, you get the idea. So the fifth root of 10 is actually 1.58. So it's pretty much just 0.58. So the rate of return that they actually want is 58%. And that's all I want to talk about today. I actually hope it helped. I actually learned this today and found it quite helpful. So you might find that helpful as well. Other than that, please rate, comment, subscribe, and please don't forget to follow us on Twitter and like us on our Facebook fan page because we really need followers and fans to do what to continue what we're doing. So thanks a lot. Please rate, comment, subscribe again, and I'll see you guys next.